Welcome back to TruePath Finance Australia. Today we're talking about something that confuses a lot of Australians when comparing home loans: comparison rates. You've probably seen lenders advertise one interest rate, and then another slightly higher comparison rate underneath. But what does that actually mean? And why can two loans with the exact same interest rate end up costing very different amounts? In this video, we'll break down what comparison rates actually are, why they exist, how lenders calculate them, the limitations borrowers need to understand, and examples that show why the cheapest advertised rate is not always the cheapest loan overall. Before we begin, this video is for general information only and does not constitute personal financial advice. It does not take into account your objectives, financial situation, or needs. You should consider seeking independent professional advice before making any financial decisions. One of the most confusing things for Australian borrowers is the difference between an interest rate and a comparison rate. Many people think the lowest interest rate automatically means the cheapest loan. But that's not always true. That's where comparison rates come in. A comparison rate is designed to give borrowers a better idea of the total cost of a loan. It combines the interest rate plus many common fees and charges. This helps Australians compare loans more fairly. Here's a simple example. Two loans might advertise exactly the same interest rate, but one loan has much higher fees. That means the comparison rate becomes higher. This is why comparison rates can sometimes reveal costs hidden behind a low advertised rate. Sometimes lenders advertise a very low interest rate to attract attention, but the loan may also include annual package fees, offset fees, application fees, higher ongoing costs, so the cheapest advertised rate isn't always the cheapest loan overall. This is the really important part many Australians miss. Comparison rates are calculated using standard assumptions, usually based on a $150,000 loan over 25 years, but many Australians borrow far more than that today, so your real costs may be very different. A comparison rate is useful, but it's not perfect. Real borrowers may use offset accounts, make extra repayments, receive lender discounts, refinance early, or borrow very different amounts. That means the actual cheapest loan for you may differ from the comparison rate. Here's another example. A loan with a slightly higher interest rate may actually save you more money if it includes a strong offset account feature, especially if you keep significant savings in the account. This is why choosing a home loan is about more than just chasing the absolute lowest rate. When comparing loans, don't just focus on one number. Ask, what fees apply? What features matter? Is there flexibility? Does this loan suit my long-term plans? Comparison rates are a very useful tool for borrowers, but they should be used as a starting point, not the only factor in your decision. The best loan is not always the one with the lowest advertised rate. Smart borrowers focus on the full picture, not just the headline rate or the comparison rate, because the right loan depends on your goals, your cash flow, your future plans, and how you actually use the loan. This content is provided for general information only and does not constitute personal financial advice. TruePath Finance Australia exists to help Australians understand how the financial system works, in plain English. If you found this educational video helpful, make sure you subscribe, follow TruePath Finance Australia, and share this with someone looking at home loans right now. Thanks for watching, and we'll see you in the next education video.